The uncomfortable truth about financial markets is this. Retail traders don't lose because they're stupid. They lose because they are playing a game they don't understand, inside a system that was never designed for them to win. Every year, millions of intelligent, motivated people enter trading with the same belief. They think if they study enough indicators, watch enough YouTube videos, or find the right strategy, they'll finally be on the winning side. And for a short period of time, some of them even are. They get a few winning trades, feel a surge of confidence, and believe they've cracked the code. That moment is exactly where the trap begins. Markets are not neutral environments. They are not classrooms where effort is rewarded fairly. Markets are competitive ecosystems built around liquidity, positioning, and asymmetric information. And retail traders, by design, sit at the very bottom of that hierarchy. The real question isn't why do retail traders lose sometimes? The real question is why do they lose consistently, predictably, and at scale? To answer that, we need to stop blaming psychology alone, stop blaming bad discipline alone, and stop pretending this is just about emotions. Those explanations are comforting because they make failure feel personal and fixable, but they miss the deeper structure of the game. Retail traders lose because they are structurally misaligned with how markets actually function. Before we break that structure down, let me give you context. Most retail traders start the same way. They come in with hope, curiosity, and just enough capital to feel the stakes. They learn the basics, open a platform, and begin reacting to price. They believe price movement itself is the opportunity. If price goes up, they buy. If it goes down, they sell. Simple cause and effect. But price is not the cause. Price is the result. And when you build decisions around results instead of causes, you will always be late. I've watched this pattern repeat for over a decade. Different markets, different instruments, same outcome. Retail traders focus on entries. Professionals focus on positioning. Retail traders chase confirmation. Institutions create conditions. That difference alone explains most losses. Now let's talk about the personal context that almost no one wants to admit. At some point early in your trading journey, you probably experienced a period where things worked, a small streak, a moment where the market rewarded your actions. That moment is dangerous because it creates a false narrative that you are improving faster than you actually are. The market allows this to happen, not out of kindness, but because early wins pull you deeper into risk. They increase size, frequency, confidence, and emotional exposure. They turn curiosity into commitment, and once commitment is high enough, the market begins extracting payment. This is not random. This is how liquidity is built. Retail traders are not losing because they lack intelligence. They are losing because they are the liquidity source for participants operating on a completely different level of intent. Which brings us to the first critical mistake. Retail traders believe the market exists to offer opportunities. In reality, the market exists to facilitate large position transfers. Every trade requires a counterparty. Every large order requires volume on the other side. Institutions cannot enter or exit without someone willing to take the opposite position. That someone is almost always retail. This is where the pain begins. Retail traders buy where institutions sell. Retail traders sell where institutions buy. Not because retail is foolish, but because retail trades reactions, while institutions trade locations. Think about where retail traders are most confident. Breakouts, strong trends, obvious patterns, clear confirmations. Those moments feel safe because they align with human perception. Momentum looks like certainty. Consensus feels comforting. But consensus is exactly where risk is highest. When price becomes obvious, liquidity becomes abundant, and when liquidity becomes abundant, large players finally have room to act. This is why so many retail traders experience the same frustration. They enter trades that make sense. The setup is clean, the logic is sound, and yet price reverses immediately after entry. Stop losses get hit with surgical precision. Profitable trades rarely expand. Losses expand faster than expected. This is not bad luck. This is structural positioning failure. Retail traders are trained to trade signals. The market is designed to trade behavior. The deeper pain is that retail traders often sense something is wrong, but they can't articulate it. They feel manipulated. They feel hunted. They feel like the market knows where they are. And in a way, it does. Because retail behavior is highly predictable. Predictability is death in competitive systems. This predictability doesn't come from individual weakness. It comes from shared education, shared tools, shared indicators, shared timeframes, and shared emotional responses. When millions of traders learn the same concepts and react the same way, they form clusters of behavior, and those clusters create liquidity pools, and liquidity pools are targets. The market doesn't care about your analysis. It cares about your position. Retail traders lose not because they choose the wrong direction, but because they choose the wrong place, at the wrong time, with the wrong expectations, inside a game they misunderstand. And once you understand that, the question changes. It's no longer, how do I find a better strategy? It becomes, why does the market need me to lose?
The biggest mistake retail traders make is not emotional, it's conceptual. They misunderstand what kind of game they are in. Retail traders believe trading is about prediction. Professionals understand trading is about inventory management and liquidity exchange. This misunderstanding creates a cascade of errors that compound over time. The first error is believing that being right matters more than being positioned correctly. Retail traders obsess over direction. They spend hours debating whether price will go up or down, building narratives around news, indicators, and opinions. But direction is the least important variable in a professional trading framework. Liquidity comes first, timing comes second, direction comes last. Institutions don't ask, where will price go? They ask, where is liquidity concentrated and how can we access it efficiently? Retail traders don't think this way because they're never taught to. Education for retail is built around signals, patterns, and entries. This creates the illusion that execution is the edge. In reality, execution is meaningless without context. This leads to the second mistake, trading where risk feels lowest instead of where risk is lowest. Retail traders feel safe trading confirmation, breakouts, trend continuation, strong momentum candles. These moments feel logical because they align with visual clarity. The market appears decisive. But clarity is precisely what attracts crowds, and crowds create liquidity. When everyone sees the same thing, someone is providing the other side of that trade. Retail traders enter late not because they're slow, but because confirmation is inherently delayed. By the time confirmation appears, smart money has already built or distributed positions. This is why retail traders experience repeated stop-loss hits near highs and lows. They believe they are unlucky. In reality, they're entering after the market has already done the work. The third mistake is scale blindness. Retail traders think in single trades. Professionals think in campaigns. Retail risks a fixed percentage per trade and expects that trade to resolve cleanly. Institutions build positions over time across price ranges, scaling in and out. They are not emotionally attached to individual entries. They are attached to exposure and inventory. This mismatch creates pain. Retail traders get chopped up. Small losses accumulate. Confidence erodes. They begin adjusting strategies, indicators, timeframes, anything except the underlying model. Each adjustment increases complexity without increasing understanding. Eventually, something worse happens. They internalize the loss. They believe the problem is them, their discipline, their psychology, their emotions. This is the most damaging phase because it keeps them trapped inside the wrong framework while blaming themselves for failing at it. The market benefits from this. A trader who believes failure is personal will keep trying. They will keep funding accounts. They will keep providing liquidity. They will keep searching for solutions that don't challenge the structure itself. This is the real pain. Retail traders are not just losing money, they are losing clarity. They are stuck in a loop where effort increases but results do not, where learning feels endless but progress feels invisible, where every loss reinforces the belief that they are missing something obvious. What they're missing is not a technique, they're missing the correct lens. The turning point comes when a trader stops asking how to win and starts asking why losing is so common. At some stage, if a trader survives long enough, a realization begins to form. It's subtle at first. They notice that price often moves aggressively against obvious setups before moving in the expected direction. They notice that news doesn't move markets the way it should. They notice that their best analysis often produces the worst outcomes. This is not coincidence. This is structure revealing itself. The revelation is this: markets are designed to maximize participation before delivering resolution. Price does not move to reward accuracy, it moves to facilitate transactions. Liquidity is not a side effect of price movement, liquidity is the objective. Once you understand this, the market stops feeling chaotic and starts feeling intentional, not malicious but functional. Large players require size. Size requires counterparties. Counterparties come from predictability. Retail traders are predictable because they are trained to be. They use the same indicators. They watch the same levels. They respond to the same stimuli. This creates behavior clusters. Behavior clusters create liquidity zones. Liquidity zones become targets. The market doesn't hunt individuals. It exploits patterns of behavior. This is where smart money thinking diverges completely from retail thinking. Smart money is not trying to predict price. It is trying to access liquidity with minimal friction. This means creating conditions where others are willing, eager even, to take the opposite side. Breakouts create urgency. News creates emotion. Volatility creates fear. These are not problems for institutions. These are tools. Once a trader understands that the market's primary function is liquidity transfer, everything changes. Stops stop feeling personal. Losses stop feeling random. Entries stop being the focus. Context becomes everything. The revelation is not that retail traders are bad. The revelation is that they are playing a role, and the moment you see the role, you gain the option to stop playing it.
To understand why retail traders lose, we have to move away from surface explanations and look at the market at its functional level. Markets are not prediction machines, they are liquidity distribution systems. Every professional participant, banks, funds, market makers, has one problem to solve: how to move large amounts of capital without moving price against themselves. You cannot buy size at the top or sell size at the bottom without creating slippage, so the market must first create conditions where others are willing to take the opposite side. This is where retail behavior becomes essential to the system. Retail traders are not noise, they are fuel. Let's break this down. Retail traders trade outcomes. They respond to price movement after it has already occurred. When price breaks a high, they buy. When price loses support, they sell. This is rational behavior if you believe price movement itself is information. But for institutions, price movement is not information. Order flow is information. Smart money watches where orders accumulate: stops, pending orders, forced liquidations, emotional entries. These are not abstract ideas. They are measurable, visible, and statistically reliable. When price consolidates for a long time, it is not doing nothing. It is building inventory. It is allowing both sides to position themselves.
The longer the consolidation, the more energy is stored, not because of volatility, but because of commitment. Once enough commitment exists on one side, price can move aggressively against that side to release liquidity. This is why false breakouts are so common, not because the market is deceptive, but because false breakouts are efficient. They generate urgency. Urgency creates volume. Volume creates exit liquidity. Now let's make this concrete. Consider a classic retail scenario. Price trades in a tight range. Resistance is clear. Multiple rejections. Retail traders wait patiently for the breakout. When it finally happens, momentum looks strong. Volume increases. Confirmation is everywhere. Retail buys the breakout. But who is selling? It's not other retail traders. It's institutions distributing inventory they accumulated quietly inside the range. Once distribution is complete, price no longer needs to stay elevated. It reverses, stops are hit, late buyers are forced out, liquidity is captured. From the retail perspective, this feels like manipulation. From the institutional perspective, this is execution. Now let's look at a real-world case. During multiple major market events, equities, forex, crypto, the same pattern repeats. Ahead of major moves, volatility compresses, retail participation increases, leverage builds. Then a sharp move occurs that wipes out one side aggressively. Take leveraged crypto markets as an example. Before major liquidations, funding rates become extreme, retail positions become crowded, longs pile in during bullish narratives, shorts pile in during fear. Those positions are not hidden. Exchanges, market makers, and large players have visibility into positioning data, order books, and liquidation levels. They know where forced selling or buying will occur. That knowledge allows them to engineer moves that trigger cascades. Once liquidation begins, price movement accelerates not because of new information, but because of forced execution. Liquidations are not decisions, they are obligations. This is why retail traders often say, "The market moved so fast I couldn't react." Exactly. Speed is not accidental, it is the mechanism. Retail traders lose because they are reactive in a game where reactivity is punished. They respond after positioning is complete. They enter when risk is highest, not lowest. Smart money, by contrast, is patient. It enters when price is boring, when nothing is happening, when retail is disinterested. That's where risk is lowest, because liquidity is being built, not released. Another critical insight is time horizon mismatch. Retail traders operate on short-term emotional cycles: fear, hope, relief. Institutions operate on longer horizons: days, weeks, quarters. They can withstand drawdown because their goal is not to be right immediately. Their goal is to control exposure. This mismatch guarantees that retail will be shaken out. Retail traders feel pain quickly. Institutions feel pain slowly. Pain tolerance determines survival. The final insight is perhaps the most uncomfortable. Retail traders believe the market is trying to reveal truth. In reality, the market is trying to extract commitment. Price does not show you where it's going, it shows you where participation is highest. If you follow participation blindly, you become part of the inventory being managed. This is why most retail traders never develop an edge. They search for better signals instead of better context. They optimize entries instead of understanding positioning. They focus on accuracy instead of expectancy. Until that changes, the outcome does not change. Retail traders lose not because they lack effort, intelligence, or discipline, but because they operate with a model that is fundamentally incompatible with how markets move capital. Once you understand why retail traders lose, the next question is unavoidable. What actually needs to change? Not tactics, not indicators, not another strategy. What needs to change is how you frame risk, timing, and participation. The first practical shift is learning to trade locations, not signals. Retail traders wait for confirmation because confirmation feels safe. But safety in markets is not visual, it is structural. The lowest risk trades rarely look convincing in the moment. They occur when price is quiet, compressed, and directionless, when participation is low and commitment is being built. This means you stop asking, "Is this breaking out?" and start asking, "Who is trapped here if price moves?" That single question forces you to think in terms of positioning instead of prediction. The second shift is redefining what a good trade looks like. For retail traders, a good trade is one that immediately goes in their favor. For professionals, a good trade is one that makes sense even if price moves against them temporarily. This requires smaller size, wider tolerance, and a different relationship with drawdown. If a trade only works when price behaves perfectly, it is not a trade, it is a gamble. Reducing size is not a sign of weakness, it is the cost of staying in the game long enough to learn. Institutions survive because they can absorb discomfort. Retail traders fail because they demand instant validation. The third shift is understanding expectancy over accuracy. Retail traders chase high win rates. Professionals chase positive expectancy. A system that wins less often but wins larger will always outperform a system that wins frequently but loses big. This changes how you view losses. Losses are no longer failures, they are expenses. The only unacceptable outcome is uncontrolled loss. Finally, you must stop trying to outsmart the market and start trying to align with it. This doesn't mean copying institutions, it means understanding their constraints. They need liquidity, they need participation, they need emotion from others to operate efficiently. When you recognize where those needs exist, you stop fighting price and start positioning around behavior. These are not tricks, they are adaptations, and without adaptation, no trader survives. The hardest lesson for retail traders to accept is not technical, it's existential. The market does not owe you clarity, it does not reward effort, and it does not care how confident you feel. Retail traders lose because they approach trading as a personal challenge, while the market operates as a systemic process. Once you see that, failure stops being mysterious, it becomes logical. You stop asking why the market keeps doing this to you and start asking what role you are playing in its structure. That question alone separates traders who repeat the same cycle for years from those who finally break it. Trading is not about being smarter than everyone else. It is about being less predictable than the crowd. If you want to survive and eventually thrive, you must stop reacting and start contextualizing. Stop chasing movement and start understanding motivation. Stop searching for certainty and start managing uncertainty. That is the real work of a trader. If this perspective challenged the way you think about markets, subscribe to the channel. This is where we break down the mechanics that most retail education avoids and rebuild trading from the ground up without illusions. Leave a comment and tell me which part of this hit you hardest. The honest the answer, the more value you'll get from what comes next. Master yourself. Master the markets.